Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three large cap stocks to consider buying amid the recent market pullback. And the three well-known large cap names we're taking a look at are McDonald's, Halliburton, and Amazon. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So as I'm recording this on Friday morning, the Nasdaq was up about 0.9%, and the S&P 500 was up about 0.5%, and this came after the big drawdown that came, and it started in the afternoon on Wednesday, and then continued on Thursday with the S&P down about 1.6% and the Nasdaq down about 1.8%. Most of that selling came directly related to the Fed and Jay Powell's speech on Wednesday. And then there's also some worries about the possibility of a government shutdown. But it's kind of worth taking a step back and wondering how much has changed, and kind of take a deep breath to see how much has changed since Powell spoke, because the Fed, or Wall Street, got what it was expecting. The Fed paused, and investors were already expecting at least a 40% chance of a 25 basis point rate hike at one of the Fed's next two meetings to close out 2023. And then furthermore, investors have been pricing in higher rates for longer, since back in early April and May, when it became obvious kind of once again that inflation wasn't going to fade as quickly as they hoped. So the yields on the 10-year and 2-year U.S. Treasuries have spiked since Wednesday afternoon, but that really only extended the prolonged rally since the spring. So all told, the Fed pretty much remains done tightening. The updated outlook from the CME Fed Watch tool showcases that as well. And the outlook for earnings remains robust for 2024 and 2025 based on the most up-to-date Zacks data. So we're calling for about 11.9% earnings growth from the S&P 500 next year, and then another 11.3% in 2025 versus a projected decline of 3.3% in 2023. So that hardly showcases a big recession on the horizon. The jobs market still is really strong. So the backdrop remains really rather positive. And despite Powell and them saying they're going to be in wait and see mode and they might hike 25 basis points again, they're kind of just giving themselves some breathing room that if they have to turn up the heat a little bit more, the market won't freak out. And actually having this pullback in stock prices is something Powell and the Fed will appreciate, that the market's not just going into complete rally mode again. And we also have to remember that September is a historically difficult period for stocks. Of course, it's not easy to look at the big picture when the market's fading, and the S&P 500 and the Nasdaq are now sliding further below their 50-day moving averages, or at least as of yesterday, but we're trending back in the right direction. And it's also worth noting that the S&P 500 and the Nasdaq are approaching oversold RSI levels. And so that's a good sign. So we'll see maybe if in the next couple days this rally extends. We could see some more chop around in September. But overall, the bullish backdrop does seem in place for the fourth quarter and heading into 2024, even if we see some more choppiness in September and even more selling. So with that in mind, we're taking a look at three established large cap names that investors might want to consider buying as the market fades a little bit further in September. And the first one up is McDonald's, which trades on the ticker MCD. It is a fast food superpower. I mean, everyone pretty much knows what McDonald's is. It's been thriving, even though the business hasn't changed much in decades, but it's gone all in on mobile ordering and delivery while making the occasional menu tweak. So something really worth pointing out is that the McDonald's app was downloaded 127 million times worldwide in 2022, which blew away Uber Eats at 60 million, DoorDash at 42, and Starbucks at 34. So McDonald's doing really well in the digital business. The company posted 11% global comps growth last year, and then 17% comps growth in 2021, and its adjusted earnings climbed about 9% and 50% respectively during that stretch. So really big growth over the last several years. The company topped our Q2 earnings and revenue estimates over the summer and upped its guidance, with comps up another 12% last quarter. The company also said that its digital sales in its largest markets accounted for about 40% of the revenue there, So digital, once again, they're going all in on digital, and it's proven to be a big bet that's paying off. So Zacks estimates call for McDonald's adjusted earnings to surge another 14% in 2023 and then another 8% in 2024, with its revenue projected to climb about 10% this year and then another nearly 8% next year. So that's just a steady top line growth and bottom line growth. And its positive earnings revisions help it land a Zacks ranked number 2 buy at the moment. And then there was actually some news recently. So there are about 40,000 McDonald's locations around the world, with roughly 95% of those owned by franchisees. And McDonald's just announced recently that its franchise fees are set to rise for the first time in roughly 30 years. So the franchise royalty fees for U.S. restaurants are set to rise from 4% to 5% for people who are opening new locations. So that's worth noting. That's in the news this morning. So that could pay off in the long run as those fees climb for franchisees. And then in terms of the price performance, its shares have roughly doubled the S&P 500 over the last 25 years. And over the last 5 years, McDonald's is up nearly 70% and 12% during the past 24 months versus the S&P 500's 4% dip. The stock is now down, though, around 9% from its 2023 highs and trading 22% below its average Zacks price target. So that's a solid entry point, possibly. And it's trading slightly below its 10-year median at 22.3 times forward earnings and 25% below its highs. It is below its 200-day and 50-day moving averages and under its 50-week moving average. That said, it's rarely stayed below that 50-week moving average for very long over the past 10 years. And McDonald's is now near oversold RSI levels. And if we look at a 5-year stretch, it's at its most oversold level since October of 2022, when the market bottomed most recently. And then, so that's a good sign. And we should also note that McDonald's is an S&P 500 dividend aristocrat, so one of roughly 65 of those companies who have both paid and raised the dividend for at least 25 straight years. And overall, I mean, McDonald's pitch is pretty straightforward. Customers know what they're going to get from the fast food titan, and that's something Wall Street really appreciates as well. So certainly worth considering McDonald's at these levels, for both the near term and the long term. And now we're going to transition to Halliburton, which trades in the ticker HAL. Halliburton is an oil field services standout that works throughout the entire life cycle of a project. So the company's products and offerings help oil and gas companies with everything from exploration and well construction all the way to abandonment activities. So the entire oil and energy sector benefited from those soaring prices between the fall of 2020 to the summer of 2022. And then on top of that, oil prices have really held up a lot better than people expected, even though they're still well off their highs. And that said, oil prices have climbed really steadily over the last 3 months, up from around $70 a barrel in June to nearly $90, or right at around $90 today. So some on Wall Street think prices could climb all the way back to $100 a barrel amid production cuts and ongoing demand. And energy stocks appear to be on the comeback trail as well amid those rising oil prices. And as Wall Street realizes that the energy transition that many had hoped for certainly won't happen overnight. So the Zacks energy sector is now up about 10% in the last 3 months. And this is versus the S&P 500's 1% drop. And then just more broadly as well, that the Russian invasion and the ongoing Russian invasion of Ukraine has greatly disrupted global gas and oil supplies and rerouted lots of things, and having new players come into the market to fill that void. And it's really fighting the reevaluation of the status quo, which likely means more drilling and more energy independence. So Halliburton topped our Q2 estimates in the summer, and the company's total revenue increased 14%, with operating income up 41% year over year. And it's both of its core segments, so that's completion and production and drilling and evaluation. Its units delivered strong margin performance across all of its regions. So strength across the board, always good to see. And then Zacks estimates are calling for its 2023 sales to climb 15%, and then for Halliburton to jump another 8% in 2024. Plus, its adjusted earnings are projected to soar by 41% this year, and then another 14% in 2024. In this outlook showcases growth and stability within a key part of the oil sector, even though it's coming up against a massive year in 2022, where it posted 33% revenue growth and 99% adjusted earnings growth. So really big extension of its recent strength as well. Halliburton currently lands as Zacks ranked number 3 hold, and its oil and gas field services industry ranks in the top 22% of over 250 Zacks industries. And then earlier this year, the company raised its dividend by 33%, with it yielding about 1.6% at the moment. And overall, Wall Street's really high on the stock. 18 of the 20 brokerage recommendations that Zacks has are strong buys alongside 2 buys. So Wall Street really loves Halliburton. And overall, the stock has soared by about 220% in the past 3 years to blow away the S&P 500 and the Zacks oil and energy sectors. 120% climb. Halliburton is up around 4% in 2023, but it's surged about 33% in the last 3 months, alongside those rising oil prices, which we talked about earlier. And at around $41 per share, it still trades 16% below its average Zacks price target. So that is a good thing to see. The stock's also back above its 200-month moving average, which it's kind of chopped around over the last few years. So it's back above that key longer-term moving average, and it's trading well above its 50-day and 200-day moving averages. It's trending back towards that 50-day, but it completed that golden cross earlier this summer, where the shorter dated moving average climbs above the longer term moving average. So that's a positive sign that the stock price is heading back in the right direction. And the recent drawdown has the company trading at around neutral RSI levels after being at well overbought. So that's a good sign. And then on the valuation side, Halliburton's trading at a 30% discount to its 10-year median at 12.2 times forward 12-month earnings. This also marks an 11% discount to its highly ranked industry. So that's a good sign. And then in conclusion, Halliburton should benefit from the fact that oil exploration and drilling are gradually expanding after years of slowing output as more countries race towards, as I say, greater energy independence. And perhaps most importantly, near-term and long-term investors, that oil is no doubt going to play a pretty massive role in the U.S. and around the world, even as people are pushing towards EVs and various renewable and alternative energy. So overall, Halliburton looks to be in a good position in both the near term and long term. And now we're going to close out with another big name in a totally different area of the economy, and that is Amazon, which trades in the ticker AMZN. The company remains the titan of e-commerce and cloud computing. The stock looks like it's still sitting in a nice spot for long-term buyers. It suffered a massive fall from grace that many people have talked about for a while as it made big bets and faced a slowdown from its huge days of growth. So its former CEO, Jeff Bezos, who everyone still knows, stepped down in the summer of 2021, and its new CEO, Andy Jassy, has been attempting to recalibrate the company along with lots of other big tech spenders to focus on profitable growth and not just spending at all costs as we live in this new interest rate environment. So they're focusing far more on the bottom line than ever before. So that's a good sign. So if we look back, Amazon posted about 22% revenue growth in 2021 and then 9% growth in 2022. So that was the big shocking downturn after it had been on a massive run, posting about 30% average annual revenue growth for the 5-year period ending in 2021, which beat all of its other big tech peers like Apple and Microsoft and Alphabet. Most recently, the company crushed our estimates in early August, blowing out our adjusted earnings estimates by 85%. So this marked its third straight huge beat and helped prove that its cost-cutting efforts are working. And its overall revenue for the second quarter rose by about 11% as well, which also beat expectations. The cloud growth continues slow as companies are cutting back, which is also hitting Microsoft and other cloud players. But overall, that growth is going to be there because eventually the spending will have to at least stabilize and pick back up, because cloud is just so important to everyone's business, and they can't risk just completely slowing that down or stopping spending. So Amazon Web Services, which is their cloud business, still had about 32% market share as of last quarter. This beat Microsoft and Google, who are in second and third place. And then all of the other players are much, much smaller at around 4% or lower. So that's a great sign. And then in terms of e-commerce retail sales, Amazon's doing about 38% of the market versus Walmart is in second place at around 6.3%. So that just shows how dominant they are in two huge key areas of the market. And then looking ahead, we're calling for about 11% revenue growth this year, and then another 13% revenue growth next year to get all the way up to about $644 billion. And that's adding about $60 billion and then $70 billion to the top line during those two stretches. So even though the year-over-year growth percentage figures are changing as the numbers get bigger, they're still adding so much to the top line, $60 billion roughly this year, and then another nearly $70 billion next year. And then on the bottom line, we're calling for 214% earnings growth this year and then another 38% growth next year. So that's what Wall Street will like to see as well. And then overall, its positive earnings revisions help it land a Zacks ranked number one strong buy. So its current year estimates up 44% since its last report, and then its 2024 estimates up 32%. And we should note that its most accurate estimate for 2024 is up another 16% above consensus. So trending heavily in the right direction for Amazon's bottom line. And Wall Street's really high on the stock overall. So of the 38 brokerage recommendations that we have, 32 are at strong buys, 4 more at buys, and 2 more are at holds. So nothing sell, and 32 of those are at strong buys. So overall, Wall Street's really high on the stock. It's currently trading 30% below its average X price target, even though its shares are up about 730% in the last decade to blow away the Nasdaq's 250% climb. That said, though, the stock is still down about 12% over the last 3 years. This is lagging way behind the Nasdaq's the 25% jump, and still actually trading 30% below its peaks, despite being up by about 55% in 2023. The stock is back below its 50-day moving average and now hovering around its 200-week and 50-month moving average. So those really longer dated trend lines are worth paying attention to, but might find some support there. It's trading 65% below its highs at about 45 times forward 12-month earnings. So still pricey. People want to see that come down even more, but as its earnings outlook looks even better for 2024, that could be a good sign. And then if we look at its PEG ratio, which factors in its longer-term earnings growth outlook, it sits at 1.3 versus the Zacks tech sector's 1.9, which is also 50% value compared to its own 10-year median. So overall, Amazon's pitch remains the same, especially that it's, as I'm saying, it remains the same in the sense that it's a cloud giant, e-commerce powerhouse. It's in entertainment and much more. Those are all going to be important factors in people's lives and companies' lives for the foreseeable future. And it's now focused heavily on profitable growth going forward. So these 3 stocks are certainly worth looking at amid the September market pullback in a historically weak period for the market, especially as we see at the top that the overall bullish backdrop for the market seems to be in place heading into Q4 and further beyond that. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.